The rising cost of living, but also increasing interest rates, have reversed some of the huge rally we've seen in house prices over the last 2 years. In this video, we'll look across 4 different housing markets, the UK, the US, Australia and Canada, to see exactly what's happened, why, and where we might be headed. And there'll be video chapters so you can move between those 4 regions, although there are commonalities, so you might want to watch the whole thing. This video is sponsored by NordPass, which lets you securely manage your passwords across all of your devices. So let's look at the housing market outlook in a bit more detail. Let's begin by looking at the UK housing market. But remember, if you do want to fast forward to your region, then there'll be chapters in this video. Beside me here, you can see the nationwide monthly house price index, and here I've shown you the year-on-year increase and sometimes the fall in that index. And currently you can see that it is a fall of about 3% year on year. But of course that follows a period of very high growth, which was more than 10% year on year, which is fairly exceptional. Now, if we look at how much we've fallen from the previous all-time high, the drawdown in the house price index, you can see that we're about 5% below the all-time peak. But also notice that we haven't gone into free fall, as many people were saying we would. Now it seems as if house prices have kind of stabilized. But also if we compare this with previous house price falls, this one's not particularly large. If we compare it with the one in 2008, for example, that was considerably larger. It was over 20% and it lasted for some time. This one's looking a bit more like the fall that we saw in the 1990s, although the duration certainly isn't as long so far. But the key point, and this is true of all of the markets we'll look at, is that we've just come off a period with huge price increases. So prices in the UK, for example, increased by about 27%, and they've only fallen by about 5% off that peak. So as long as you didn't buy recently, as we did, then you're still looking at pretty good gains on your house. This is pretty cold comfort for new entrants to the housing market who simply can't get onto the housing ladder and may be stuck renting. Now, of course, the government is aware of this problem, and they did try to create schemes which would help first-time buyers, such as the Help to Buy scheme, which has recently ended, but that didn't solve the primary problem, which is that prices are just too high. The reason why governments usually go for a kind of financial solution is that it's something you can turn around fairly quickly, whereas increasing housing supply takes a long time and it's fraught with difficulties. But as you can see in this article from the Times, the Help to Buy scheme was problematic. It only applied to new build, it had price caps, and also the problem was that it exacerbated the problem. It inflated house prices such that if people did buy at those very high prices, they're now looking, in many cases, at negative equity. Now, one of the drivers of increasing house prices in the UK is foreign buyers. And if you look at the number of land registry titles registered to individuals with a foreign address, it's certainly surged over the last decade or so. So the Labour Party solution to the housing problems of the UK is partially to restrict or tax heavily foreign buyers of UK property, whereas the Conservative Party solution is to bring back something like the Help to Buy scheme, so maybe we'll see that in the autumn budget. But it was interesting to see that Skipton Building Society has now started offering 100% mortgages, although these are very restricted. This is primarily targeted at people who are currently renting and who've been doing so for some time, and it also restricts the mortgage payments to be the average of their rental payments over the last 6 months. So again, I don't think that these financial solutions address the primary problem, which is lots of people and not enough houses. Increasing supply just doesn't seem to be materializing. Now, as a member of our community, you get access to this house price model, which is very simple. It simply looks at the average income in the UK and it extrapolates that trend with a best case, central case, and worst case scenario. And it also has a mean reverting trend, which is the price to income ratio. Multiply the two together and you get a forecast for UK house prices. Now, based on the latest update from Nationwide, you can see that the central case is now a fall of about 1% per year over the next 4 or 5 years. In the optimistic case, where the price to income ratio surges even higher, in other words, house prices become even more unaffordable, and you get very strong earnings growth, well, in that optimistic case, house prices would go up by about 8% per year. Whereas for the pessimistic case, we'd expect a 12% fall year on year for the next 3 years. But certainly based on the price action so far, it looks like we're going for something between that median case, the central case, and the pessimistic case. Now, if you run a business, one of the problems is that you have to do all of the jobs. You have to be the IT guy, you also have to be the admin guy, and you also have to produce all of the content, like this video. But what you don't want to do is to spend a lot of your time worrying about security. And one of the things which NordPass Business lets you do is to manage the passwords for your entire company. So let's say that one of your employees wants to change their password. One of the ways you could do that is to email them or maybe message them the password, but that's not particularly secure and you have to wait for them to respond. Whereas if you do that with NordPass Business, it's almost immediate. And of course, it's a secure way to share things. Another headache is that your employees are not using secure passwords. So one of the great features of NordPass Business is that it actually lets you monitor the security and do an audit to see how secure your employees' passwords are. So if you're interested in learning more about that and you want to see NordPass Business in action, just use our promo code, which is PensionCraft Business, no spaces, or look at the link in the description below. Now let's turn to the US market. As you can see, Jerome Powell at the latest monetary policy meeting said that activity in the housing sector remains weak, largely reflecting higher mortgage rates. So the Fed is fully aware of this problem. In fact, you could say that it's almost manufacturing it by tightening up credit conditions and increasing interest rates. That is how monetary policy is transmitted. One of the ways is to make houses less affordable and to reduce the disposable income of average families. And if we look at the Case-Shiller index, which represents the average price of a house in the US, you can see that that's now almost falling, and this was published in February. It comes with quite a big lag. At that point, house prices were still rising year on year by 2%, but heading south fast. But with Case-Shiller, you can also break it down city by city. And you can see the huge surge here because I've normalized prices to be 100 at the beginning of 2019. So you can see that Phoenix in Arizona, for example, increased hugely over that 2-year period. But it's also fallen back a lot from that high. Now the dots that you can see on the graph are how far back you'd have to go to compare to prices right now. And in the case of Phoenix, for example, you'd have to go back almost 2 years to see prices where they are today. So in Phoenix, for example, prices are where they were about 2 years ago. So if we compare the drawdowns, in other words, how much we've fallen off the all-time highs, you can see that some cities are pretty close to those highs. Miami, for example, has really not fallen back much at all. Neither's Atlanta or Chicago, whereas San Francisco has fallen back about 14%. It's a huge fall from the peak. But of course, many of these places where the falls are largest are the ones where the rallies were largest. So unless you were unlucky with the timing, you bought right at the top, then you're actually probably okay. You're not talking about negative equity. Now, if we want more timely data, we can turn to Redfin. Beside me here, you can see the average house price broken down month by month for each year. So 2020, you can see the average house prices were around $275,000 to $300,000. And in 2021, we take a big step upwards. Whereas in 2023, we're actually below where we were last year. So currently in April, we're looking at a 3% year-on-year fall. Now, if you look at the percentage of houses which have had a price drop compared to their listing price, that's actually pretty high. Currently it's at 4.8%. Last year you can see it reached 6.5 to 7%, but certainly we're still not seeing house prices all being sold at the asking price or higher, which we did see during the height of the housing market euphoria. For the US as well, PensionCraft members get this fair value model, which you can see on our website, pensioncraft.com. And here you can see that the central case is no price movement. In other words, the market's going to be flat for the next 3 or 4 years. The pessimistic case is we're going to see a 10% year-on-year fall, and the optimistic case is an 8% rise year-on-year. Personally, I think we're much more likely to see something around the central case here. That's because wage growth in the US is still pretty good. There aren't any signs of a recession yet, although there might be. So probably we're going to see the US market just kind of stabilize from here. Now let's turn to the Australian market. In Australia, as we see in other developed markets, inflation has pretty much peaked now. We are seeing disinflation, but the rate of inflation is still pretty high year on year. Now, the central bank still can't take it easy and reduce interest rates, but it can start to think about not increasing interest rates. If we look at the policy rate expectations, these are backed out of the overnight interest swaps market. Notice how for all of the large central banks, excluding Japan, we're pretty much at the end of the rate hike cycle. So at this point, central banks are just going to keep rates where they are, watch inflation very closely to see if the trend of disinflation, falling year-on-year inflation, continues. If it does, and it starts to fall back closer to their target rates, then they'll probably start to think about cutting rates. And of course, that would be a big positive for the housing markets in all of these countries. If we look at house prices across the state capitals, and here we're looking at the 3-month change in dwelling values, notice how we did have a big negative dip, but it was fairly short-lived. And now it looks as if we're about to see the end of that dip. So for example, in Sydney, we're seeing house prices increase at roughly 3% over the last 3 months. And if we look at Australia as a whole, year on year, we're still seeing price falls of about 8%. But if we break it down by region, again, year on year falls. But over more recent periods of time, notice that some regions are now increasing. So for Australian house prices as a whole, they're actually up by 1% over the last 3 months. So what we're not seeing here is a free fall in house prices. What we're seeing is a stabilization. Finally, let's turn to Canada. And if we look at how much inflation exceeds the Bank of Canada's 2% target, you can see that we are seeing disinflation. It is starting to fall from its peak. And the Bank of Canada at least expects that we're going to get back to very low inflation by the end of 2023, something that's much closer to its target. If that's the case, if that actually happens, then the Bank of Canada can actually start to cut rates. And as the Bank of Canada points out in this graph, you can see that housing activity remains pretty weak in Canada, with the volume of sales down considerably compared to that huge rally period. There were quite a few pension crafters that complained about house price increases at the time, saying that they were kind of crazy. But now what we see is that the bank says that it expects that housing activity will stabilize around the middle of the year. And what the bank also points out is that strong immigration to Canada will probably increase demand for housing and stabilize prices, if not increase them. If we look at data from the Canadian Real Estate Association, you can see that the prices have now peaked. They've fallen from that peak, but now it seems as if they've also stabilized. And as we see elsewhere, the year-on-year falls are quite considerable in some regions. For example, in Ontario, they're more than 16% compared to a year ago. If we look at new listings, supply is extremely limited. It's actually at a 20-year low. So clearly people are holding back their house from the market, knowing there's probably going to be a fall if they do manage to sell the house. But the Canadian Real Estate Association is fairly bullish when it comes to 2024. What they're expecting is an almost 5% year-on-year increase when we get to the end of next year. And that's also true if you break it down by city and by region for the end of 2024. So again, the pattern here seems to be stabilization of house prices, maybe even a slight increase over the last few months, and certainly not a very large fall. So as a kind of global overview, the overall pattern seems to be one of disinflation. Year-on-year inflation is now falling, albeit slowly, and that certainly allows central banks to potentially stop raising interest rates. Maybe not in the UK, where inflation's still above 10% and looking very sticky, but certainly in places like the US, but also Australia and Canada. However, in all of these regions, labour markets remain very tight. In other words, there are lots of jobs for every person looking for a job. Now that's actually a positive for the housing market, I'd say, because what it means is that people still have gainful employment and they can still afford to buy a house. The drawback is that it could actually make inflation more sticky if we get price wage spirals. and that would keep policy rates higher for longer. But certainly the pattern we see across all of these developed markets is one of house prices stabilizing. So I don't think we're out of the woods yet. I think there are still various scenarios in which house prices could fall further. Here we're talking about extreme things like a US debt default, which would have a huge negative impact on sentiment, but also economics in the US and elsewhere, but also less shocking things. For example, a secondary spike in inflation that would keep rates higher for longer, and that would be a drag on housing markets. Or perhaps we'll just get weak growth, which would increase unemployment. And again, that would be bad for the housing market because people are less secure in their jobs. But still, for now, it looks as if we're not seeing the crash which some people were forecasting on YouTube. Not me, it has to be said. So don't forget our offer. If you do want to use NordPass, it's brilliant for managing your passwords, particularly if you're a business user, and there'll be a link about that in the description beneath me. And as always, thank you for listening.